Hello, hello. Good morning, good afternoon. Good afternoon, Ramesh. Hey, morning, Morris. How are you doing? Everyone doing fine? Any surprises? Fantastic. Why not? Why not? It's been a great year or great month so far. Good morning, Sanjeevani. I think is it your first time that you are joining, Sanjeevani? I don't recall seeing this name. I'm sorry if I missed it earlier. Oh, okay, your first time. Cool. Welcome, welcome. Morning, Anil. So today, I think the main agenda for today will be to get into details of some of the option strategies. I know I wanted to talk about ratio spread last week. We didn't have a time. We had a lot of other stuff that we discussed. So today I want to talk about not just ratio spread, but then I thought maybe I'll cover others also. And I think in last week chat, someone also asked for, hey, how about the synthetic? So I will talk about that. So this is little more. I think during the boot camp last year I had covered. I did not cover all of these. I probably just named these strategies in the passing. But today maybe we will dig deeper into some of these strategies and understand when you can use it, right? How you can use it. And again, you don't have to use it always. Figure out if it works. If it doesn't work, that's fine. I mean, the best strategy is the one that you can stick with for longest period of time. And that's fine. I don't use all of them, but I thought at least it'll be good to go through this with you all. That's main. Otherwise, I think the general stuff we're gonna talk about it. Little bit on the macro side, what's happening. A lot of action that has happened this week. We have a new administration and a lot of new stuff that's coming around. We'll talk about little bit on the crypto. A lot of action on the crypto side as well. I guess that's it. And earnings season is coming up, so maybe if you want to talk a little bit about that. But that's largely an agenda that I have planned for today. Want to keep time for answering any questions that you may have around stocks or general investing. Um, Happy to discuss that. I mean, so thank you for you all to joining every Saturday morning. Want to make sure that this time is useful for you. So make it interactive, ask questions, and make sure you get what you want from when you're spending these couple of hours here. Anyone else joining for the first time? Let me see who else. Benjamin. Hey Benjamin, is this your first time? Okay, welcome. So how did you find us? Maybe just through the meetup or? Okay, cool. Cool. Um, yeah, if who else is new is I think.
Mhm. Hi, Vivek. I'm new. I'm joining for the first time.
Hey, Sayuj, welcome. So, if you can, quickly tell me what you're looking, looking to get out from this meeting and where you are in your investing journey. That will help.
Yeah. So yeah, I came to the US in 2018. So once I got the job, I started investing, and for last 4 years, I've been a long time investor,
Cool.
mostly into index fund and things like that. But recently, uh, I was looking into swing trading and things like that. Getting started on trying to understand some kind of trading.
Okay.
So I was looking to get into some community where I can learn more. I've been reading a lot of books on trading and stuff,
Okay.
fundamental technical analysis.
All
So
right.
yeah.
So at the outset, I will probably, throw cold water on on your party. I'm not a trader. I'm not a
Mm,
swing trader. I am mostly long-term investor, and
yeah.
my focus is on to do whatever I can to stay long-term investor. I do trade options on daily basis, but
Mm,
those are not like a zero DTE options. I have more of a I'll sell options, 40, 45 days out. My whole intent is to make sure I reduce my cost basis, which helps me to stay longer in the market, right? So if we're
Got it.
looking for day trading strategies or technical strategies, I do use some indicators, but those are not my main way of investing.
Yeah. Got it. Yeah. I'm also not into day trading. Yeah.
Okay, cool. Yeah, but I'm happy to discuss around, individual stocks, etc. We do get into reviewing S1s, into, earnings. Now earnings is coming up, so I will review some of the earnings, etc. But that's what I'm focused on. Cool. Anyone else wants to share? Yeah, a lot of new people, so I think I'm probably not gonna go with asking individual ones. We'll run out of time. But anyone else wants to share? Maybe one more new person.
Hi, I'm Serena.
Hey, Zarina, how are you?
Hi, good. I'm under host visors there. So, good. I just transferred some funds from an IRA to another IRA. So, I'm looking to invest that. And there's a lot of, I don't know, it's just overwhelming. Like every time I go into the stock screener or, anything, I just can't. Then I get analysis paralysis. So,
Yeah, yeah.
I've done some options as well. Like during pandemic, I did the zero GTE.
Okay.
So, but it just got kind of really risky after a while. So,
Yeah,
um,
yeah. So,
yeah,
yeah, I've not touched zero DTE. I know some folks do it, but that's
yeah,
not really my cup of tea. That's like hit or a miss. And
yeah.
I've been doing options for almost coming to 8 years now.
Oh, great.
But no zero DTE. I mean, zero DTE were not even there when I started.
Oh,
Uh,
okay.
So no zero DTE for me.
Uh-huh.
But yeah, I mean, even for a new like Sayuj, I think he got a right start saying I have been invested in uh, index fund and chill until you figure out which industry you're interested in, which stocks you want to focus on. Stay with the ETF, index broad-based index ETF. If you are again, every individual is different. I didn't invest in, I can only talk about myself because I don't know anyone else. I don't know your history. I did not invest in individual companies unless I'm interested to review the companies, follow the company, look into their earnings, stay with ETFs. And I think that itself is great. SPY did 25%, including dividends last year, right? So what else can we ask for? It needs zero investment or of time to understand. You don't have to worry about earnings. You don't have to worry about a company going down. You don't have to worry about, um, maybe picking a wrong CEO. You're getting the best 500 companies of US, and that itself has done pretty well. Even if we just um, invest in SPY, we are better off than 85% of the fund managers out there, right? Let other 15%, enjoy their glory. Most of the fund managers don't even meet, forget, beating the benchmarks. They don't even meet their benchmarks. And most of the fund managers have trailed last year, even in 2023 as well as 2024, just S&P 500. So thank you for sharing your story. All right, Ben says, let's make money, not get burnt on options. Yeah, and I have a hard time in, again, there are two ways of the options are not bad. The only problem is how you use the options. It's a tool that you can use whichever way you like to. Me personally, I have been able to stay longer and invest in the market for longer time because I started using options. Until I knew about options, I was always very hesitant to get in the market. So for me, it has worked out wonderfully good, but there are people for whom just options don't work out because I don't use options to take those gambling, bets to buy out of a money calls, etc. Most of the folks that you meet in this meeting are also the ones that mostly are on the selling side of options, not on the buying side of options. Ben says I lost money on GME, AMC last year. Yeah, I never traded. I still remember all the GME and AMC and other meme stocks that had happened in 2021 that brought up a lot more retail investors. And, however, most of them came on the learning on the wrong side, which is just buying out of money calls. Doesn't work in long term. Long term doesn't work. Yeah. What's my strategy with options? I think we need to have a 14 hour session just to talk about the strategy, Satish. My strategy at a very high level, my overall investing strategy. I think when you're talking about strategy, you shouldn't talk about only one portion like options. I focus on overall portfolio level, right? And I'm happy to lose money on the option side if it helps me on the long portfolio side. So overall, my investing philosophy is buy great companies if you understand the business. Otherwise, I'll just stay with the ETFs and hold them for long term. Now, where options come into picture is if I'm trying to buy a company, I want to buy it I don't like the current price, but I will be willing to buy it at a price which is 5% cheaper. Instead of putting a limit order, I'll sell a put against it. Right? So I use options as a substitution of a limit orders so that I get paid while I'm waiting for the stock to, if the stock doesn't hit my limit order, I don't get paid if I only have a limit order. But if my stock doesn't hit my strike price, I already got paid for waiting. So first during the acquisition, I'll use options. Then while I acquired the stock, how do I stay invested with the stock? Stocks are very volatile. You could get scared out. Stock fall down 5%, 10%. You might be like, oh gosh, I need to get out. So I use options to reduce the cost basis of the stock, right? So if I have reduced my cost basis of the stock by 20%, 50%. I have some stocks which I own free and clear. I still own all the stocks, but I've sold so much option premium that I've recovered all the money which I put in. It's like playing with the house money. If you have reduced your cost basis, then when the drawdown comes like we had in 2018, where like market fell on 14% in Q4. Then the next one I remember was in 2022, right? Which like the tech was down 40%, S&P was down 23% or 18%. I didn't have to get scared out because many of the stocks cost basis was already have reduced it. So my focus is to how to increase the longevity in the stock market. And if that means reduction of the cost basis helps me, that's what I'm using options for. And of course, I use option day-to-day basis on trying to hedge a portfolio and seeing it is too bullish. Everyone is bullish, but I don't want to sell my stock because it will incur capital gains and all that stuff. I'll probably do some negative delta trades. Again, there's a lot of videos I covered in a boot camp on how to manage your portfolio or hedge your portfolio using options and all that stuff. So that's my overall investing philosophy. Options is a part of it, which helps me to stay in the market. To be very frank, I lost money in options in 2024. But I'm very happy that I lost money in options 2024 because my rest of the portfolio means it has done great, much better than S&P. Same was the case in 2023. But my overall portfolio is way better than I would have ever expected. 2022, I lost money on the long stocks, but I made a lot of money on an options account. So that's it. My idea is to make sure I stay invested in the market, and options help me to do that. And that's why I focus on. Okay, Nyanga says, okay, yeah, training videos. Thank you. Oh, yeah, training. I don't think I put all the training videos on YouTube, but thanks, Satish, for sharing the YouTube link. But those training videos are definitely on my website, optiongeek.com. And if you just register, you don't have to pay anything for it. Go to the menu, boot education. Under that, you have all the links for beginner, intermediate, all the way to advanced levels. Cool. All right. All right, so let's get into today's session. Today is a little more intermediate to advanced because we're gonna talk about strategies. So if you are new and trying to deal with options for the first time, that may be a little overwhelming for you, but let me give you a link for, or at least show you where the bootcamp videos are. You can do, go through them at your own speed, and so that at least you understand some of the terminologies that we're talking about. Sorry, go ahead.
I already pasted the link for the bootcamp.
Uh, no, I think you're given the YouTube link. I don't think all the videos are on YouTube. I'm a little bad on the YouTube side. So, but if you get onto the website, you'll see beginner. Uh, so this is the last year's boot camp, right? Basic intro, monthly income generation, then getting little more details into, what are the strategies you can use for. And all the way, if you go to advanced, you can have, you know, go as much detail as you want to. You want to get into the Greeks of it, but hedging and managing your portfolio using options is drill number 12, right? And then you have other stuff in between. Cool. Alrighty. So let's get into today's discussion. Like I said, we'll focus on some of the strategies, and then we'll give you update on the little bit on the macro and the crypto side. Bring your questions if you have any, and then we'll take it from there, right? As always, anything that we discuss here is not a financial tax or any kind of a investment advice. You should do your own study, and whatever works for me may not work for you. So everyone have to find out what works for them, and if this is not your thing, find out how, if option doesn't work for you, figure out what else work for you, right? Some people are swing traders. I have nothing against them, just that it doesn't work with my personality. Some people are day traders, and I know some of them are in the meeting also, but that doesn't work with me. That's not what I want to focus on. So figure out what works for you and stick to it. I'm gonna repeat it. The best strategy is the one that you can stick to. Don't jump around and trying to say, oh, I saw Vivek or I saw XYZ, and let me try this, let me try that. Maybe try it for a few months, for a year, to figure out where you find your sweet spot, and just stick onto the sweet spot. So you says any thoughts on crypto ETFs? Example, Fidelity BTC. Yeah, what do you want to know? I mean, uh, there are many other different flavor of ETFs coming up. If I were to do on a crypto Bitcoin ETF, I would rather stick with the top two of them. One is IBIT, BlackRock. Other one is FBTC, which is Fidelity. I personally focus more on IBIT. I in fact, when it came out, I bought FBTC. Then when the options were enabled on Bitcoin ETFs, I switched from FBTC to IBIT because the options are a lot more active. You have a better liquidity on IBIT. Yes, it is. Let me just bring this up. And there's a lot more volume on IBIT. This is from a BlackRock iShares Bitcoin ETF. So pretty, I mean, looking at all the other Bitcoin ETFs, FBTC is another one, right? Look at the bid-ask spread is very wide, whereas on IBIT, the bid-ask spread is much better. It's a more developed options market in it. So I prefer IBIT. But if you are just buy and hold, then only thing then you need to focus on is whichever is charging the least amount of fee. But for me, apart from fee, what also matter is how well developed the options market is. So I chose IBIT, but I think ARKB has the least amount of fee. You can just look for, there are, stick to the top two or three. IBIT, FBTC, ARKB. I think these all three are fine. Figure out which one is the least of management fee and maybe stick to that. But if you want to deal with the options, reducing cost basis and all that stuff, then IBIT is the best one. They have the most depth in the options market of all these Bitcoin ETFs. And when you talk about crypto ETFs, lot of other ETFs are also coming up. Now with the new administration, I think everything is up for you would know how many things are gonna hit you if you are in a crypto. I have seen filing for a Doge ETF of all the things. XRP, Solana ETFs, many more conversions are coming up. So a lot of activity on the crypto side. I'll talk a little bit about it. For the max sound reporting, yes, I'll have a chart for earnings. So it's gonna be a busy earnings week. The next one. Is there an index fund for these? I uh, I saw one filing for an ETF for Bitcoin friendly companies. I don't remember if there is an index or for ETFs or not, Bitcoin ETFs or not. Cool. Okay, so let's get into today's discussion. Congratulations to all of you who have been investor. We hit a new all-time high once again this week, based on all the optimism that has swirled the market, not only the US market but the rest of the world, based on new administration and how business friendly they are, or they, let's say, um, they portray they are, because we have to wait for the results. But we think, and market thinks it's a very business friendly administration, and based on that, market has been ripping higher. So we hit a new all-time high. And what for the year, S&P is already close to 4%. That gives me little jittery, saying, hey, we already hit like 4% for a month. How long can it continue, right? But I don't have a crystal ball. No one else has, so we don't know. It will be perfectly fine, and I'll be perfectly okay if we can get some, corrections or downside movement in the stock, right? Things just stock just doesn't continue to grow infinitely in one direction. So if there is a little weakness, that's perfectly fine. That's what the market is. It will go high, it'll go down. For the week, I think except most of the, so tech was all green except the Texas Instruments. Consumer electronics, Apple is still struggling with the perceived lack of demand in China. And also now the questions are, what are you doing? Have you lost the race on AI? No new so-called innovation coming up from Apple. We haven't seen much stuff from Apple ever since, I think, Steve Jobs. After he departed, Tim Cook has been running company just fine. But the questions are now, what's your next game, right? How long can you continue to milk your existing customer? Having a better camera, better memory is just not cutting the mark. So a little bit concern on Apple. I'm not gonna write them off. They got a huge cash pile. They have a 2 billion plus devices that people carry around the world. And somehow I think that Apple should not be in a consumer electronics. It should be in a consumer staples. If you lose your iPhone, or if you lose your phone, or if phone goes bad, you're not gonna wait and now look for the best deals. You're gonna go out and get another phone immediately. It is as essential as food for us, food and toiletries. So maybe we should put Apple in consumer staples rather than consumer electronics. But I guess other than that,
Vivek,
cyclical is all fine. Yeah, go ahead.
who has enough money to buy $1,000 iPhone?
You don't know how many people have money, especially in the world.
Well,
So,
Vivek, when my Xiaomi broke, which cost about how much did it cost? about $150, and they had to fix it. I just went across the street and bought another Xiaomi, less than $200.
Oh yeah, I understand Apple is not for everyone, but then Apple is also working to maybe try to capture some of the market which Xiaomi, etc., the other brands have captured. So go a little lower in the price point so that they can then expand to the Asian countries, right? In India, in China. Apple is losing market share at the top end in China. And of course, some of that also has to do with the geopolitical tension and whatnot. But I can't write off a company which has got such a strong balance sheet. And Apple has been very, very prudent in making use of their balance sheet. I don't see Apple going and buying any company. When was the last time you heard Apple doing a big acquisition? I don't even recall. So Apple has been very prudent in their capital management. They could continue to buy back their stock, even if they don't increase the revenue. I mean, Apple, not much revenue growth, guys. So one big criticism of Apple is they are not growing. That's fine. And it is a very valid criticism, right? If you look at the revenue growth, that's kind of stagnated on 2% for last three or last 2 years, like 2%. In fact, in 2023, Apple revenue even fell down, right? So they didn't even, except 2021, they haven't posted like double-digit revenue growth in any year. But look at this balance sheet, right? You can't go against a company with $100 billion plus sitting on their balance sheets. It's and they can continue to buy back their shares, reduce the outstanding shares, and even if they don't increase the revenue or the profit still stay the same, you'll continue to benefit as a shareholder. So again, I'm not writing them off. If you look at this, they've been reducing their share count every single year, right? For all 5%, 7, 6, 4, 3, 3. So don't write them off.
Oh, Vivek, I'm
Big
not writing
money
them
can
off.
do a lot of. I mean, if they start to looking at acquisition, maybe if they give a hint to the market that we want to pursue a little more aggressively, maybe market will change its tone.
Vivek, I'm not writing them off, but it's just everybody's complaining about inflation. I get Lenovo phones for less than $50 now.
Yeah, but there are diehard Apple fans as well. I mean, the fact that there are 2 billion devices means people have still bought it. Now Apple is trying to milk them through the services, which wasn't even a business 5 years ago. They didn't even used to report services as a separate segment because it wasn't big enough. And now that has grown to become what, 80%, $80 billion? Where's the services revenue? Now it has become like $96 billion business. And that wasn't even a thing, a few years ago. So, but I agree. They have kind of market is perceiving that they have lost the race on AI, and then the Vision Pro. They tried to do something new with the Vision Pro, didn't really work out. Who wants to spend $3,000 plus $3,500 on on big ski goggles? That really didn't work out. So they are trying to do stuff, and even if that doesn't work out, even if revenue doesn't grow, if they can continue to maintain the current customers, continue to milk them, and do a prudent capital allocation, still it'll be able to provide a decent returns. You can't expect the returns of, let's say, like some of those AI companies are doing. Cigarette companies revenues has been growing down for now decades, but some of those companies are still, from a total shareholder return perspective, they're still done good for the shareholders. They are dividend paying because the cash rich companies, they continue to buy back their stocks. So revenue growth is not the only metric that we should look at. There are, when you're looking at overall company, there are other things that also come into picture, right? Of course, revenue growth is, I would love Apple to grow by 10%, 20%. But if you're already so big, and if you don't have a new product coming in the market, you're going to become a mature business. And then if you're a mature business, you need to behave like a mature business. That means start returning more capital to shareholders, which is what they are doing. Means, what do you think of ISRG? ISRG, no debt and in billions cap. So ISRG, I haven't done a detailed deep dive into ISRG, but they have a very good moat. So from a business perspective, I think it's a good wide moat business that they have, and a great business model in terms of selling your Da Vinci surgical robots. And basically it's a Gillette's business model. And then continuously, ring the cash register when the consumables are used for those robots. So once a hospital has purchased a Da Vinci robot, have trained a team of doctors on surgeons on how to use it, it is very difficult to then, switch to another competitor. So they have a wide moat, which I like from a business perspective. But now let's look at ISRG. Or maybe I'll take a note of ISRG and give you like I
Yeah.
actually do an overview. Five
It's
minute.
done extremely well over the years. So,
Yeah, the stock has done great. First, so when I look at a company, stock is the last thing I look at. First, I look at overall some of the business metrics, how they're performing. And then I find it's a great company, a good company to invest in. Then I look at, okay, what's the current valuation it is trading at? And then I decide the price point. So I took a note of it. Maybe I'll come back to ISRG next week. I'll bring up my model of, how I look at the company, and then we can take it from there.
thank you.
Cool. All right, any other questions? Thought on Netflix post earnings, what would be a good option strategy? I don't even know. I mean, if you're bullish on Netflix, then you could find an appropriate price point to sell a put against it. Or, I mean, you depending on what's your outlook on Netflix is. So again, options are a way to express your opinion about a stock. I have no opinion on Netflix. I don't own Netflix. I have not followed Netflix I mean, I've followed it just to get a around on what's the market sentiment on the streaming business is. Netflix has surprised everyone. Bill Ackman probably nursing his wounds because he sold Netflix when it fell down after he took his initial investment. And if he had just held to it, it would have been up more than $2 billion. So even the smartest Wall Street managers like Bill Ackman can go wrong sometimes, right? But again, depending on what's your outlook persona, what's your outlook around Netflix, then we can talk about how to express that outlook using options. I don't have I did not look into the details of Netflix earnings. I know they smashed the records for the street expectations for subscriber. I think the expectation was what, 8 million additional subscribers. They got what, 18 million. Some of them could also be, I would say, pulling front, the all the subscriber growth, because remember, from a next year onwards, they're not going to report you on your subscriber numbers. So Netflix has told, don't focus on subscriber numbers because now we are becoming a mature company. Focus on our revenue growth. So my tinfoil hat part of my brain says maybe they pulled in all the subscriber growth this year so that they can blow the expectations out. And if next year subscriber growth doesn't even happen, who cares? They're not going to report those numbers anyway. But in any case, I mean, it's a great business. It's the biggest streaming business. But if you need to understand what's the pricing you're paying for the growth, what it has. I have not really looked into the Netflix as a from a business metrics. So I don't know, but if you're bullish on it, then we can create some option strategies to express that. Thoughts on MU? MU is Micron. I'm actually little bullish on Micron. And in fact, I had an option trade on Micron. I had a put spread on Micron. I've not done the detailed analysis yet on Micron, but I think with all this AI stuff, I want to place my bets at a different supply chains, different players in the supply chain of AI, right? One is of course hyperscalers, which I have exposure to. The other one are chip makers. The third one could be your the tool providers for the chip makers or the fab plants itself, right? MU comes in on the high bandwidth memory side, which you will need when you're doing any when your AI model is doing inferencing. There are two companies that makes memory of these kind. One is SK Hynix, another one is Micron MU. SK Hynix had reported results this week, and kind of I think they had hinted on weakness. Again, I don't own SK Hynix, so I don't know what exactly they reported, but maybe somewhere I saw that the results were not as good, or maybe the guidance was not as good as what the market was expecting. So SK Hynix stock fell down, and I think even the Micron also probably fell down because of that, in sympathy with it. But uh, I do want to have exposure to it, and I in fact had a put spread on it just to, hey, in case it falls down, I'll maybe buy a little bit with a defined risk rate. But for me, I think I had a put spread when it was close to 100 or something, went to 109, got automatically closed, and maybe I'll look for another opportunity. But I do want to have exposure to MU. From a valuation perspective, I know when I last looked at 2 weeks ago, 3 weeks ago, maybe when I was trying to see if I want to get exposure, I think it was not super expensive. So my idea was to own it. If it, anyway below 110, etc., I'll be fine to own it. So I don't think it is again, that's just my valuation, right? That under 110, I'll be okay to own it. Pelosi plays. I don't follow Pelosi, but yeah, she's been one of the best stock pickers. Forget all the Wall Street hedge fund managers. Uh, Pelosi's record has been much better than everyone else. Can you look at NTRA? CEO Steve Chapman, market cap $23 billion. Okay. Is this what, Netera? NTRA. I don't think I've heard about this ticker anytime. But I'm just guessing NTRA could be. This is a biotech company, right? Something related to pharma or bio, or this is what company is this? NTRA. Okay, molecular testing, sir. Yeah, right. It has something to do with biology, way outside my comfort zone. But what I'll do is I'll at least bring up the standard business metrics that I follow for a company, and then we can have a discussion on it. I don't understand the biology or pharma space well enough to make an informed decision. I don't know what drives the businesses in this one, but I'll bring up how does it rank in terms of the various quality metrics that I want to track for any company. Nitin is asking, for MU type put spread, what delta did you write at, or it doesn't matter? I mean, it does. So I think I had my short put at 30 delta, and then the long put was maybe $10 wide. It was a $10 wide wing. Again, depends on if the stock has fallen too much and it is way below where again, the delta is for me to get a safety of margin. If I think that the stock is already at a bottom, or the price point where I'm comfortable buying it, then I might just go at a 40 delta. If I think, oh, no, 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 I don't like this price point, I need to have another, go further down, then obviously I'll be selling it on a little lesser delta. Market condition dictates the 30 or 40 delta. No, not necessarily. So generally, you would see, hey, if you want to have again, the 30 delta concept comes from the fact that I just want to sell an option and keep the premium with me. And in case if the stock falls down and hit that price, I'll be okay to own it. But my main intention is, hey, I just want to keep a premium. So we're selling at 30 delta, that gives you 70% probability of profit. Right? And when you give a 70% probability of profit, and then if you look at the normal distribution, that is your one standard deviation move. Right? So that's where the concept of 30 delta will come around, is if you do 30 delta trades, you probably win 70% of the time, which is because the stocks generally don't, stocks behave in a normal distribution. Sorry, I'm getting into the details. So we'll finish this detail just in another minute and then we'll get back into our agenda. So a normal distribution curve, which is what, if you go and look into the market's returns or the stock returns or performance over longer term, they'll try to, a lot of things in the nature, even on the financials, are normally distributed. And in which you have 68.2% of the time, you'll have a one standard deviation move, which is close to 70%. That's where a 30 delta comes. But I will pick up a delta if I'm like, hey, it is very close to the price point where I want to do. Maybe I'll do ATM. Then the premium just gives me a good enough buffer. So that's what I'll focus on. But if you don't know what price point you want to buy, then 30 delta is where it comes from, because based on the one standard deviation move. Anything happening on options advisor training GPT like tool? I'm not sure I understand your question, but I guess there are a lot of people who are trying to use GPT tools. I mean, we have algo based trading going on for decades. More than half of the trades that happen on the markets are driven by algos. So now some GPT tools will also feed those algos. But I think I don't know what exactly you meant. But if your question was, I'm assuming your question was using GPT like tool, etc. So I'm sure people will use it. All right, so coming back to the market, I think I answered all the questions. All righty. Yeah, so this week was a great week. Overall, year to date, I think, look at an Apple. Apple is now in what? This is called a correction territory. Right. So I don't know why they call it correction if the stock moves down. First thing, because, hey, come on, if it's a good business, stock is supposed to move up. Maybe this is it's not a correction. It could be a mistake. It again depends on what the business is. If the business is good and the stock just fall down for no reason, then it's a dislocation. It's not a correction. But I'll stick to the general term which market uses. Apple is in correction territory. It's down 11%, 20%, more than 10% down is correction, more than 20% down is bear. Rest everything else green. I hardly see, any fewer of them are reds. Consumer defensive, not that great. But tech has been doing good. Semiconductor good. Financials great. Financials were one of the best performing sectors for the last year, right? So what else? I think nothing to complain. So sector-wise, year to date, industrial has sprung up, and over the last week now to be top performing with 7%. I want to focus on S&P 500. That if you are new investor or you, I mean, my biggest position is S&P 500, right? It's still done 3.73%, for close to 4%. What else you can ask for? Consumer staples hasn't done good. Consumer staples is a little defensive sector. Utilities have done good because of these power, the so much of requirement of a power from these hyperscalers to run their AI models. Generally, utilities and consumer staples are called as grandfather stocks or grandfather sectors. You just collect coupon in terms of dividend. They don't move much. Don't expect too much of a capital appreciation. But 2024, utilities surprised everyone, right? 2023, I think, yeah, 2024 as well. They were one of the top performers, but because of a demand from AI, right? And this has been the best first week stock performance for a new president since 1985.
Mm.
So that's like more than 40 years when a new president have sworn in and taken the charge. This has been the best week, which is weekly performance since 1985. Doesn't mean anything. 1 week performance has got no relevance when we are talking about in years, right? Just a stat. Market P is above 30, right? So when a P is above 30, seems expensive because never had you. There are very few times when you will have P above 30. Market say, oh my God, it is expensive. If you look at a Case-Shiller PE, which is your cyclically adjusted PE, that's like second highest in the history. Prior to this, it was high as in during the dot-com bubble. Now this time it's this like end of Friday it's the second highest. So from all the traditional measures, market looks pretty expensive. But before you go and sell your stocks, why fixating on historical P doesn't make sense. Like we've been talking about, historically average P is close to 16, right? In the band of like say 14 to 18, right? And so if it is a 30, it's super expensive. Now, before I get into this chart, if you go back and look at 1800s, 1870, 1880, since when the records have been kept, that time the historical P used to be around 10 and 11, 10, 12. Then it started to become higher and became like mid-teens. And then in 2000 onwards, we are seeing in mid-20s. So maybe we are willing to pay more. So I don't pay, I don't just sell off a stock just because, the market overall is trading at a very high PE. Because the companies are different, the environment is different. If it is zero interest rate environment, of course, I'll pay up for 25 PE, 30 PE. Compare that with when you had in 1980s and 70s, 17% interest rate, then I'm not willing to pay for 20 PE. I can get risk-free 17%. Why would I pay up 30% or like 20 PE for a company or for the market? So I just can't compare historic PE with the current PE because the environment have changed. The companies have changed, right? Now, if this is an exhibit from a BofA Global Research. The financial leverage in the companies, non-financial companies, now the financial leverage has come down, right? Higher quality composition than the prior decades. So the type of companies that are now in S&P 500 are better, more asset-light companies. 1980s, most of the companies, the top companies on S&P 500 were all manufacturing companies, huge capital-intensive companies. You need to buy plants, machinery, larger payback periods of those companies. Nowadays, the top companies in S&P 500 are capital light companies, are technology companies. So the composition of the companies have changed. You don't need to invest the same amount of a dollar to get the same amount of a return, right? So for those companies, yeah, I'll be willing to pay up a little more than what I was historically paying up for. So if you look at this chart, look at the mix from 1980s from manufacturing. Now the manufacturing is a very small part. Right? And innovation companies, which is basically a lot of tech companies, communication services companies, their share has grown higher, and those are capital light companies. So no surprises that people are paying up for it. Right? Look at the free cash flow margins by the decade for the 10 largest stocks. Okay, forget about 1950s and 60s. The companies didn't even make they were all negative. But 1980s, 90s, 2000, the free cash flow margin is like 10%, 15%. I can't compare the same companies with the same yardstick when you have a 2020 company's free cash flow margins are like 27%. So whenever you're talking about any numbers, and I get surprised when, analysts or whoever, right, on the YouTube or on Twitter, just focus on, oh, the P is expensive. Expensive compared to what? What am I paying up for? My phone is expensive than what I used to pay 20 years ago. Yeah, but look at the phone. How many things I can do on my iPhone now? Prior to that, I had a Nokia phone, right? 20 years ago, the brick phones. The phones are different. The things you do is different.
Vivek, in the 90s, the PE for S&P 500 was 13. So 30 definitely seems kind of costly.
Yeah, because you were also paying 10%. The free cash flow was 10%, and you can get a much better return on treasuries than what you can get now. So where else are you going to go? Again, I'm not saying that the 30 is cheap, but I'm saying it's not that you should just sell off your portfolio and take the cash and put it into the matters. Understand that you just can't compare blindly. You can't compare the previous P with the current ones. The context has changed. So you need to keep the context in mind. That's what I'm trying to say. I'm not super bullish on the market right now. I'm trying to hold my deltas but I'm not bearish. They're saying, hey, it should crash because P is at 30. Right? That's not the case. So focus on other stuff. Now looking at a forward PE, look, it looks expensive. It's not cheap. I'm not.
Another thing is, before the year 2000, Buffett was getting blamed for his company not returning as high as the S&P. So he was forced to go into .com, and then .com bust.
I mean, he did not, but he is a great investor. Well, Berkshire Hathaway has returned and made many millionaires out of retail investors. He's one of the greatest investors of all times, right? And he sold Apple. And from his perspective, yes, it is expensive. But the market has been expensive since, I would say, for the last 5-6 years. And if you had just waited on the sidelines to say, oh no, I will get into the market when it falls down a little bit, then I'll remind you what Peter Lynch used to say. More money has been lost in anticipation of a correction more money has been lost in waiting for a correction than in the correction itself. People lost so much of an opportunity cost that they waited on the sidelines. And now, if we had look at why go all the way to Peter Lynch, 2020 after 2022 correction, market is up like 54%. You could have, I'll wait. I think again, I'm not saying go all in. It depends on if your outlook is I don't need this money for 20 years, then why even try to time the market? So forward PE, looks super expensive. And again, I think the metric that Finviz uses is maybe greater than 20 is red. So a lot of reds in here. But what the analysts are saying, go and still buy it. More greens. I hardly see very fewer reds out here from analyst perspective. Again, don't follow the analyst. If you're buying individual companies, should understand what's on those companies, what you are buying in for. But these all discussions around is market expensive or not, we'll only get to know in hindsight. We will never get to know in sitting today that have we reached the top or not. Only once we are fallen off the top, then we'll realize, oh, that was the top. And I don't know where the top is. And I have no idea where the market will go this year. So all we want to do is have a tools with me so that I can stay invested in the market irrespective of where the market goes. And that's what at least I want to focus on. Right? And we still have what, 4, 5, 6 trillion dollar sitting in the money market fund. How long will it be still sitting in the money market fund? If the Fed start to cut interest rate, right now they are all earning whatever 4.25%. Another year, 2 year, you see the Fed cutting the interest rates down. They'll try to get some yield from somewhere. That money will flow into some of the stock market, because where else are you going to get any yield? So I'm not writing off the market saying, oh my God, PE 30 is super expensive. Maybe these are the companies for which you may want to pay up for. Any companies, any great companies, forget about the overall market is expensive, but any great companies in their history, very rarely you will find it trading cheaper or at a reasonable valuation. But good businesses will grow into higher valuation. Again, it should not be, let's say, egregiously higher, right? It shouldn't be that it is trading at 100 times of sales. Oh, it's a great business, it's trading at 100 times of sales. I think that's too much to digest. But yeah, trading at 20 times of sale, and it's a great business, and I see that it's it could has a runway. Maybe I'll be okay to take still some position on it. How is forward PE calculated? Forward PE is calculated based on the analyst estimates of what the company's projections, what the analyst projections are of. And then basically they'll take a average of all the analysts and see what the projected earnings are. And then where the current price is, that's how the forward PE is calculated. How does PE valuation compare to bond yields? Right now, it's pretty bad, if you ask me. PE is a 30, that means your yield is 3% or 3.33%. You could get more than that in a treasury bills at 4.25%. So from that perspective, pretty bad. You shouldn't be in the stock market. But stock market is not driven only by calculations and not driven by Excel. There are a lot of emotions, that are future projections that come into mind. Right? So from that perspective, everyone should just hold the treasury bills, because it is paying 4.25%, whereas the yield on the earnings yield of the S&P is 3.33. You add another maybe 1% of dividend, 1.5%, maybe just equate to treasury bills. Then why even take a risk if we can make that in treasury bills? But participants are not rational, right? So, and that's why the market is where it is. So we had a 26 executive orders in the first day, more than any administration in the history. And executive orders could be repealed by after 4 years. When if the new administration come in, they could repeal it, because it's not a law. It's a decree by the executive branch and can be reversed. And some of these were actually reversal of previous executive orders. What other things had buoyed the market? Trump tariffs on China, right? We started with 50% tariffs to 10% tariffs. So right now, maybe or may not be any tariffs. So that has, I think the rest of the world market, I know Japanese market was up, and I saw a lot of Chinese equities. I do hold some Chinese equities. They were also up decently after the Trump mentioned that, yeah, come on guys, we want a fair treatment, let's say, not asking for a huge advantage, but currently we are not treated fairly, and he was asking for a fair treatment, means may or may not do the tariff. So this is some of the Chinese stocks that I am tracking. Pretty much like was up 4% after Trump kind of toned down the whole tariff talks. Case study on tariffs. This was an interesting chart I came across, which was around tariffs or no tariffs. companies will adjust to it. Same is the case. Interest rate or no interest rates, high interest rate or low interest rate, companies will adjust to it. It's not the amount of a tariff or the percent of interest rate that matter. It's the how quickly these are things are changed, and companies don't have a time to get to basically change the businesses, and hence you will always see a correction in the market when the interest rate goes higher, or in this case when the tariffs have gone high. Right. So there are different January 22, 2018, US announced some tariffs on solar panels, washing machines, etc. And after that, market returned almost -4% for the next 1 month. Right? June 15, 2018, another $60 billion goods tariffs were announced. Market returned 0.7%. Again, there are corrections in the market, but then companies will adjust to it. Right? Overall, tariff is not great because it increases the cost, which is at the end has to be borne by us as a consumer. Companies will slowly pass on the cost to us. And when you're talking about really long period of time, 10 years, 15 years, 20 years, don't mix tariffs or these politics talks with your portfolio. There might be a correction in the market. Market might spook when, let's say, tariffs are announced, but business will adjust to whatever the scenario is. So don't mix your politics and portfolio. Keep them two separate. Politicians will come and go. They'll make promises. Let's focus on what they're actually happening and what kind of businesses you are holding. Now, if you're holding some businesses that are 100% dependent on government subsidies or the policies of the government, then tough luck. It's a business that you're holding, that's a problem. Not that the government has changed or the government has changed its mind and now try to put tax or tariffs on this particular industry. Right? Focus more on your portfolio and what kind of companies they're holding, how you're constructing your portfolio, rather than these short-term tailwinds that will happen in markets. So Nitin says, I'm worried Trump signs tariffs on Canada maximum next week. Market tanks for a day. Sure. You know, if he does, he does. Then we'll see which companies do you own. Looking at a fear or greed index, we are neutral, which surprises me because I thought, to me, it looks like the market is a little giddy, but the statistics, the CNN number comes up by looking at 7 different parameters. That doesn't seem to be neutral. It seems that it is neutral. Last week it was in fear, but yeah, I'm not going out yet to either reduce the delta by a lot or by putting little more bullish trades. I'll wait when the market moves into fear or extreme fear. That's the time to go out shopping. Right now, it's just maybe do some delta neutral or do covered calls and stuff like that. Earnings coming up. This is the earnings season has started, so earnings coming up. What's the one that I'll be interested in? SoFi is very popular among retail investors. I am not a shareholder of SoFi, so don't have much interest in that yet. GM is coming up, that I will see what GM reports. ASML, great. I'm very interested in this company. I own this. So looks like Wednesday gonna be pretty busy day. You got a Tesla, Meta, Microsoft, and then ASML, Lam Research, all these 2 semiconductor companies.
Vivek, can you comment on what Lam Research? It's about $80 right now.
Okay, I've not looked at Lam Research. I know it's a semiconductor supply. It comes a semiconductor supply chain. I think they provide etching equipments for this. I don't know whether it's a KLA or they, but I have right now. Maybe let me just finish this, then we'll go to Lam Research. But anything I say right now will be. I've not actually detail looked into what the Lam Research the business numbers are, but it will be driven by all the AI stuff, because this is a company that supplies machines for your chip for your fabrication plant. Thursday gonna be super busy. We got a Apple, that's a big one. Intel, interesting to see what they have to say. Are they willing to sell themselves? Are they willing to separate their foundry business and the rest of them? And then KLA is again your chip related. I guess that's it. All right, so we got Apple on different, Microsoft. Also, then the Google, etc. probably will be week after that. So I think next 3-4 weeks gonna be busy earnings week. So next week we will discuss some of these earnings. Meta, Tesla, Microsoft, ASML, Apple. Yep, if anything, any other ones, then you tell me that. But I think these 4 or 5 I will definitely bring in. Coming to the crypto side of the house. So we got, I think the two major EO related to crypto, one was a pardoning of Ross Ulbricht, and then the second one was a EO to create a working group to focus on, to evaluate creation of a digital asset stockpile. It's a lot of Bitcoin. Maxis was wondering, maybe we will have only Bitcoin as a strategic reserve. Maybe, may not be. We don't know. Right now, the language says stockpile means maybe we'll have some other digital assets also as a part of a strategic reserve, if we get a strategic reserve at all. I'm not too hopeful for 2025, but hey, I'll take it. if the government gives it, I'll take it, right? But this is much longer period of time, much longer game. A couple of appointments, again, bullish appointments for the crypto side is Cynthia Lummis, the crypto mom. She'll be chairing the Senate Banking Subcommittee on Digital Assets. No surprises here. Mike Udaya will be acting SEC chairman until Paul Atkins joins. Again, he was pro crypto, but I guess we'll wait for Paul Atkins. What are the other things? I think the most other bullish stuff that I saw was the moment Gensler went out. His last day was January 20th. And a few days later, SEC had rescinded SAB 121, which had kind of put a lot more restrictions on the regular financial institutions to get engaged in the crypto economy. Right? And now, I won't be surprised if we see the regular financial institutions like I don't think Wells Fargo will come in, but let's say Bank of America or JP Morgan's actually started engaging directly in this ecosystem. Maybe you can, if you have a crypto holdings, maybe they will be able to take your crypto holdings like they take your deposits, and then you can borrow against it. Now the SAB 121 has been repealed, and the immediate impact, I saw that the BlackRock and Nasdaq has filed for, changes in the redemptions, because now the financial institution can directly deal with these assets. Not getting into the details, but prior, the in-kind redemption was not allowed. It was only cash-only redemption. So the overall ETF process of redemption and buying and the redemption, creation and redemption was little more inefficient, little more expensive, because SEC did not want the traditional financial services firms to do anything with the cryptos. Now they've rescinded SAB 121, and Bank of America has already said, if government ease the regulations, we will be happy to play in this ecosystem. And then a day later, SEC has rescinded this. So this is the bullish stuff that I saw. A lot of new filings coming in. Not going to read all of these, but XRPs, Litecoin and Solana, a lot of grift will also be there. Whenever you have bullish sentiment, along with the gift, you also get a lot of grift. So you have to be careful in terms of what you are doing in this ecosystem. I heard Larry Fink selling Bitcoin in WAF Davos. He was like, I was talking to a sovereign wealth fund. Conversation was having 2%, 5%, etc. allocation to Bitcoin. If every sovereign wealth fund had this conversation, Bitcoin could be anywhere. Again, these are the same people who had called either Ponzi scheme, poison, but now the winds have changed. Everyone at the end of the day, Wall Street wants to make money. Right? No one has any ethics. So it doesn't matter. So now everyone is behind it because they want to make money. So be careful. BlackRock is a big player in this ecosystem. So they have to pump up their own bags as well. Ethereum side, we saw a new company kind of being launched. It's not I mean, the company has been works for 3-4 years. If you want to know more about what Etherealize is, I would recommend listening to the latest episode of Laura Shin's podcast called Unchanged. I'll give you the name of host, and this is the podcast name. The founder of Etherealize basically came to talk about what they intend to do. But at the high end, it's a marketing agency which is gonna basically talk to the Wall Street people, pension fund managers, pension houses, family offices on what the Ethereum ecosystem is all about. Right? We don't have anyone doing that, but they're gonna focus on this one. And the next one is there is a new upgrade planned on Ethereum I guess in March or in April. I may be a little bit wrong on my the dates, but there's going to be a next upgrade which probably has got the most number of changes into it. So a lot of stuff still happening. Solana is continuing to surprise everyone. That has become the de facto blockchain for all the meme coins, right? Pretty fast. And now I'm also seeing some institutional interest in Solana. A lot of VCs are already in Solana, so not surprised that they will be pumping their bags, but some of the institutional investors are also looking at beyond Bitcoin and Ethereum. Maybe Solana is the next one. Okay, so a lot of activity is still happening, continue to happen, and with a more favorable administration, um, you know, it's not going to be a boring year for crypto. Let me put it that way. Maybe so. Looking at the history, generally the second, 18 months after the halving cycle, Bitcoin stays in the bull run. So from that perspective, this year should still be the bullish year for Bitcoin if you just go by the halving history, right? But remember, we already had a good run up because of ETS, because of new president in coming in. So whether we will continue to run up or not, who knows? But again, if you want to be in this economy, it is going to be really long term focus, right? I don't want to focus even for 1 year or 2 years. If you want to stay in this economy, it has to be really very long term focus. All right, I think there was a question on crypto. I think we already talked about it. All right, so that's on the crypto side. Any other questions? And the next our topic will be to get into various option strategies. But before that, any other question on our regular market or crypto side? No idea what halving mean. So Bitcoin supply gets cut into half after every 4 years. So if you are in this, if you let's just go and look at how the Bitcoin gets generated. And so the whole process of mining at sector, when the miners mine the Bitcoin, they are able to get only half of the Bitcoin they were able to get it 4 years prior. So the recent halving happened in 2024 March. And so 18 months after that, folks are saying maybe till 2025 is a bullish run. So let me see if I can pull out. Meanwhile, any other questions? When you're mining BTC now, it will take twice longer to mine. What makes... Yeah, you could put it either way. Or you're saying, hey, it's a, you can print dollars wherever you want to. Like gold's new supply is close to around 2.5%, between 2 to 3%, right? And so Bitcoin supply is on less, and then the supply is even coming down after every 4 years. That's why they're saying, hey, this is going to be the hardest asset. You just can't create it at your own will. If gold becomes very, in the gold prices, let's say become 5x, there'll be tons of companies who will be willing to invest a lot more money in mining the gold. There's a lot more gold available, but it is not profitable to mine it just yet because the prices are not high. But in case of Bitcoin, doesn't matter what the price is, you just can't mine it more. So that's where the halving becomes very, after every halving, you will see the Bitcoin has a bull run. All right, so let me sip some water, and then we will talk about various option strategies. So let me put out let's see if I have any Bitcoin mining or chart. I don't know when was the last time I looked at a Bitcoin chart. Me, let me go to Glassnode and see if they have halving. Oh, so Alfred has already given Coinvars. I don't think I ever visited this site. Oh, so they got a count. They got a countdown. I was looking. Let's say, so if you really want to, Glassnode has got up. There are many sites on which you can find statistics around blockchain. Come on, let's see if they shows. Oh, come on, they removed the free. Okay, charts, activity address. Oh, come on, I've not even visited this for. BTC. Not the dominance. Where's the basic pricing chart? Okay. Clearly they have now they want me to pay for everything. I'm not interested. But anyway, so uh, but it's an interesting space. There we go. But you have to be really careful on this space. Cool. So let's talk about various option strategies. So let's start with before I get into the ratio spread, and I do have a lot of animal strategies like Jade lizards and the zebras of the world. But let's start with the basics ones. Apart from basic, selling a call or selling a put, let's talk about the vertical spreads. So I think I've covered this. So if you're having a short or a small account size, or if you're dealing in where you don't have a privilege to sell, let's say, naked call, that's where we use spreads, right? So what I mean by spread is, let's say, I'll pick up any. So let's pick up Meta, right? Okay, I'm going out 30. Let's go to the March side, and so if I were to sell a 30 delta put on Meta, you know, but then it will, let's say if I'm having a non-margin and cash only account and I sell 610 short put, it's gonna block $61,000 for me to do this trade, right? Instead, maybe instead of doing this, I'll just go ahead and sell a put spread, which is like maybe do a $50 white put spread. Oops, there's a control key. 60 this and 560, right? What do I sacrifice? I sacrifice $6 or $7 in premium, but this is gonna block only $5,000 for me to do this trade. Right? So when you have a smaller account, spreads are the way to go. It also limit your risk. Right? I'm not. Let's say anything happens to Meta, government bans Meta. Not that's gonna happen, and in the bottom fell out of Meta. Your risk in this case is also protected. You're not gonna lose any more money, even if Meta falls down to 440. Your max loss is capped after 560. So if you want to reduce the how much money get allocated to a particular trade, we use spreads, right? Whether it's a put spread or a call spread. So that's a basically use of spread is to reduce the risk in the portfolio or to cap your risk in the portfolio, because now it's not an unlimited risk. I don't care. Meta goes down to 400. I know what my maximum risk is, and I'm not gonna have more risk beyond this, right? So you can cap your risk. You can reduce your reduce how much money gets allocated to this trade. That means
He was good.
if you have a smaller account, you can do few more trades because
I was fine.
this is a limited risk trade.
Thank you.
Okay, I'm seeing a background
Okay.
voice. I'll have to mute. So that's where we use spreads. You can use spread for a call spread or for a put spread, etc. Both sides, right? So now let's get on to the ratio spread. So ratio spread is basically a combination of long. So in a normal spreads, you will buy one contract and you will sell one contract. But in this case, I sold a contract, a put contract at 610 and bought a put contract at 560. Now, when you talk about ratio spread, in that case, you basically change the ratio of it. It's not 1:1. Maybe 1:2. It could be 5:3. I don't do 5:3, but I have been doing 1:2 ratio spread. Now, what is the ratio spread? Is basically again a combination of long and short, either put side or a call side. It's a high probability trade. I'll give you some examples of how I have been using it in recent times. Again, these are over years. I've tried to use different strategies. All the strategies that I'm going to talk about, I have used it in some part of a time. Do I use all of them very regularly today? Not all of them. It depends on what I find. Okay, I think this is the one which is my outlook about the company and what I see in the market, and based on that, you use it. But it's good to have these tools in your warehouse so that you can pull this out whenever you need it. Okay, so now front ratio spread is basically you are selling more than buying, means probably I will sell 2 puts and buy 1 put, or sell 2 calls and buy 1 calls. So let's take an example of Microsoft. I in fact had created that trade here. Now in this, what am I doing? 21st February expiration. I am buying 450 call, and then I'm selling 460 calls. Now, when will I do this? Number one, if and only if I hold Microsoft shares, because I have one naked call, because I have sold one more call than the, I've sold 2 calls. In this case, so what I'm going to do is I have an unlimited exposure on the option side. So I would do it if I have 100 shares of Microsoft. Or otherwise, why I want to play over there is I own Microsoft shares. And if you're using any technicals, it'll tell you maybe, 460 is a price point where if your Fibonacci level is, or this is where your resistance is, or figure out whatever if you are swing trading, you're looking at, maybe this is where it should go, right? And in that case, I can actually craft a trade which will give me on an option side, I have an ability, I have I can actually make close to $1,000 if Microsoft goes and hangs around here. But if it continues to goes higher, all the way to 471, right, then on the option, I start to lose. But hey, I hold 100 shares, right? I hold 100 shares, and those have become much more valuable. And I'm doing this trade when it is a 443. And then you have to figure out your strike price based on, are you okay with this or not? What if your shares get sold at this point of a time? And things like that. You could use it to figure out, instead of doing a plain covered call, you could also use this. You have a zero downside risk on the option because you got a premium, which is you're doing it for credit. So even if the stock doesn't move anywhere, you still got $15. So this is like 1 ratio spread. I've not used a lot more on the call side. What I have used is more on the put side. Let's say Apple. And I'll tell you why, my logic of why I've used on the Apple side. Okay. So I think Apple was around 230 or 230ish or something, because this is at 210. Okay, so not talk about the trade that I've done, but let's focus on this one. Why I would do this? Because I have an actual trade on Apple on the same strategy. And my strategy at that point of a time was, I looked at what's the 16 delta strike price was, right? And I'm like, right now the market is all saying that the Apple is going down. We have seen Apple is down 11% for the year. I look at how much more it can fall, right? And then I'm like, maybe around 16 delta, and I don't know if this is 16 delta or not. So basically I will buy a put at 215, then sell a put at 210. So basically I buy a put spread, which means if Apple starts to go down, this trade starts to make money. But if Apple continues to fall down, and at 203, maybe I'll be willing to buy it, man. So this is an automatic setting of the plan. When, sitting here, if I talk to you, will you buy Apple if it falls down 20% or 10%, 15% from now? You're like, yeah, I'll buy it. It's a great company. Or pick any other share. How many times have you told ourselves, if this company goes down 20%, I'll buy it? So I'm trying to express the same thing over here. Hey, if it falls down 5%, 10%, I have some protection because I have a put spread on it. But if it continues to fall down, I won't mind buying some of it, because now that my break even is here, on the option trade, I'll start to lose money, but maybe I'll pick up some shares at this point of a time. And that's exactly what my thesis on Apple was. And I do have an Apple trade on it. And right now, I think the point that I picked up was around 225. The peak was 225. And I think let me just see what's, yes. So this peak is 225, and then I will be able to buy it if it is, this was like 210. I'm like, if it falls down below 210, maybe I'll buy some shares. So now I have used this on Apple. I've also started to use this little bit on the, on the SPY thing. hey, if it falls, then my option trade should benefit, but if it falls on too much, maybe that's a buying opportunity. Okay, you could use it in whatever way you feel like, but this is a way in which, and I thought maybe it works for me. Now the downside of this is you get the premium that you collect is very small, right? So
Yeah.
if you are trying to use options just to collect a premium and pay your bills, this may not be the best strategy, but it's a high probability but lower income option income strategy. Plus it gives you an opportunity, in this case the opportunity to make more on the option side if the stocks fall down. So that's a little bit of a protection. Plus also you can buy it more if it falls down much further down. Again, you have to figure out, okay, if does this fit in your profile or not. Yeah, go ahead, Nitin.
Yeah, so one thing I was wondering is that so you use this strategy only if you're willing to buy, right? Because
Yes.
otherwise you would be doing selling 215 if it's just 1-for-1 regular put spread, you would be selling 215 and buying 210, right?
Correct.
So is there a strategy where the monthly income is, let's just say, 1 or 2%, like QQQ, then can I do like sell two calls and buy one, sorry, sell two puts and buy one put to increase that ratio? Or is that,
No, in this case, you are selling two put and buying one put.
yeah. Is there a strategy around that or no? People don't use that.
No, sorry. So in this case, you in fact are selling two puts and buying one put. You can do it on any ticker you want to
Yeah,
do.
but I'm flipping the strike prices. What if you flip the strike prices?
Okay, so you're saying do this 210
Yeah,
and do this 215.
yeah. Then you have a huge amount of credit, right?
Yeah, but then look at your break-even point is pretty close to where it is right now.
Okay.
And your basically you made your $500 in this one, but if your break-even point is much closer to
Yeah,
where it
yeah,
is
yeah.
right now,
Why do this? Yeah. Got it.
right? And then of course you have the rest of the risk, which in any case you have on the other one also, but then your break-even point is shifted a little farther away. So you can pick up whatever your strike price is. The best that I like to do is to plot it in the P&L graph and then
Right.
see how it will change.
So let me just rephrase that. So you would do the ratio put spread the way you were doing in case you don't have capital for the naked put, correct?
No, because I still have a one naked put.
No, not what you have. If one. So let's say I don't have $22,000 to do a naked put for Apple at 210, right? Then I can do the ratio strategy for much less, like I need $5,000 or $10,000 in the
No, no,
account.
no, no, no. Because in the ratio, the one that you've done, you still have a one uh, naked put.
One naked.
So
Okay.
you still don't have
It
any
doesn't help.
relief from that. So then you just do put spread.
So what is the advantage then of ratio versus naked?
Okay, so advantage is this. Like I was saying, what I was trying to do in that case was trying to get to this peak. The peak I was pointing was based on what some of the analysts or you look at,
Okay.
hey, Apple should trade, there is an expectation that Apple could fall 5%, 10%. So I gave myself this range to profit from an option trade. That's
Okay.
the only advantage. I'm trying to
Okay.
pin this.
Got it.
Right. And in case Apple fall down further, yeah, I'll be willing to buy it at much lower price. That's the only advantage. And like I said, if it doesn't work, what I'm sacrificing here is I'm living with a less premium upfront, which for me it is okay right now. Okay, like I said, you figure out what works for you and in terms of what you're trying to do it. But there are some of the things that I thought I'll share. If something doesn't work out based on your investing, or pick something else. Okay, number two is you need to hold it late till expiration cycle, because I have a 21st February one, and the Apple stock is actually trading right here. Now I have near 225, right? My peak is at 225, but the trade is not making any money because it decays it very slowly. You have to hold it much closer to expiration to see some gains from it. So you won't see the profit coming out even if the stock has cooperated, not soon. So you have to hold it for longer. Wider you go, higher the max profit potential. So now in this case, we've gone $5 wide, right? So our max potential is $500. If the stock comes and stays right here, I can actually sell the put spread for $5. I can close the put spread for $5, right? But I only got $13 in a premium. If I go wider, let's say instead of 210, I got 205. Now the peak is much bigger. My max profit is much higher, but then I don't collect any credit. In this case, I'm actually almost zero credit. In fact, it's 63 cents of debit. So you have to decide on what your opinion is. Yeah, wider you go, lower is the initial credit. So now there is hey, I want to collect $1, or I want to pay 63 cents, but with the opportunity of making maybe $1,000 if a stock closes at 205. So that's around another back ratio spread, which I don't do, is basically you flip it and buy two and sell one. In this case, you have a valley of death, but I mean, this gives you protection in case, let's say, Apple falls down, and and what you get 63 credit for this protection. You don't have to pay for protection, but you get 63 credit. But what the concern here is, you have a valley of death, which is this. But if you do it for a longer period of time, before this, because like as I said, you have to hold it really very close to the expiration for the decay to happen. You just don't get through that decay. You basically roll the trade to the next expiration period, and you avoid this valley of death, but get this protection almost at a no cost. In fact, you're getting paid. In this case, you're getting paid 63 cents or $63 for 100. So it's like a free protection for, let's say, if you're holding 100 shares of Apple. But what you need to be careful of, it is don't hold till expiration, because if the stock closes between these two strike prices, you will end up losing money on an option side of the house. So you need to manage it really well, saying before the decay starts to happen, you need to move it out to a further duration. I have not used this from a protection perspective. I just sell either a call or do a call for protection. But you could use this back ratio spread, not in my wheelhouse. All right, any other questions? What criteria, Joel is asking, what criteria do you use to determine whether you sell a call or a put? If I own the stock and I want to just collect a little bit of income, then I will sell a call. If I want to own the stock, but I don't like the pricing right now, and I want to get paid while I'm waiting for the stock to hit my price, then I'll sell a put. So depending on what your outlook is, again, options are the tools that you can use to create which whatever outlook you may have for a stock. You are extremely bullish, you can buy a call, which I don't do it, right? But if you're slightly bullish, then maybe sell a put. Then you pick your deltas accordingly, right? And we'll see what kind of some other crazy uh, strategies are there in which you can express everything under the sun. On the bearish back ratio, can you click the days forward to see when you start to lose money? Yes, you can plot this. With this, or you're basically, or are you saying, let's move this forward? I think I have done it on a different.
Oh, the date on the bottom. Yeah.
So let's put it. Let's keep it at the single. What did I miss? Okay. Let me go back to.
So it's expiration section, expiration +1, the normal one.
Yeah, so that's what I have, right? Oh, sorry, expiration +1. Yeah, so maybe before February, roll it out. I have used this 3-4 years ago, trying to on SPY as a hedge, but I have not used it, let's say, on last 3 years. Okay, so thank you. I always forget on this plotting to see when you start to lose money. Second one is around synthetics. I think someone had requested to talk about synthetics. I don't know is that person in the meeting today? Did any one of you requested synthetics? Someone did. Okay. All right. So synthetics is basically the general definition. Synthetic is I'm creating a trade with the same risk profile as another trade. So it is not exactly the same trade, but it is synthetically equivalent to another one. It's like manufactured to give me the same risk reward as another trade. Right? So why do we do it? Because it is maybe more capital efficient. It uses less capital. Or sometimes this is the only option available to you. Let's say your broker doesn't allow you to short the stock. Right? Then you have to figure out what's the synthetically equivalent of shorting a stock is. Right? You can use that by using options. You can create the same risk profile as if you are shorting the stock. Right? Or if you are doing a short selling on how to borrow, yeah, that's what I was saying. If you can't short sell because the stock is very hard to borrow, or in some cases, you may have to pay through your nose because the borrowing cost is very high. And I've seen like 400% cost in during 2021 in like GMEs and all that stuff. And some of those hard to borrow stocks have a very high cost of if you're trying to short sell the stocks. Then just go synthetically. I will go on the long side. I won't suggest anyone doing short unless you really know what you're doing. Many short sellers have lost their shirt and have closed their shops. So let's do go on a long side. Give me a stock. Give me any stock. Which stock should we pick up?
MicroStrategy.
MicroStrategy has everything under the sun. There are a lot of ETFs who are doing 20 other things in MicroStrategy, but let's pick MicroStrategy. So if I'm bullish on MicroStrategy, I want to buy 100 shares. how much do I pay up for it? MicroStrategy is trading at 353, so I need to pay $35,000. Fair enough? And this is what how my portfolio will look like, or my MicroStrategy position will look like. If MicroStrategy stock goes higher, I'm in green, right? And if it goes lower, I lose money on it. Right? Now, but I have to pay about $35,000 on it. Oh, but in case you don't, in this case, I don't, this is not a margin account, so probably end up doing the same stuff. But I can do a synthetically equivalent of it, which is selling a put and sponsoring it by buying a call. Right? In this case, because of the skew, there's a lot of, let's not get into the skew discussion, but let's say in a normal scenarios, you probably will be able to do it at a zero cost, zero upfront cost, or very little cost, right? My only intention of showing this right now is, look how the P&L align itself to the same as how if you were just buying a, so this is, you just bought a stock. This is how your profit and loss graph will look like. And this is what you've done, that synthetic stock. This is how your profit and loss will look like. So let's go to, this is today's date is 24th. This is how your profit and loss will look like. So you are able to create the same risk profile without the same capital outgo. Now, in this case, this is the demo account, which has got no margin availability. So it shows 35,000. If you do it in your IRA account, or for in which you have no margin, if it is cash only, then there is not much of a difference. But if you're doing in a regular trading account in which you have a margin, you will be, the amount of capital that will be blocked for doing this trade will be much less than $35,000. So it is capital efficient. Now, there are a few things that you will have, there is always a catch. In this case, if MicroStrategy pays a dividend, you're not going to receive a dividend because you don't have a shares. Dividend is only for shareholders, not for option holders. So you won't get a dividend. But you're able to generate the same risk profile at much lesser capital upfront. In a regular T margin, I think depending on brokerage firms, you get close to 25% is what you have to put up for. So instead of $35,000, it might be $7,000, $8,000 is the capital that will get blocked for doing this trade. So this is called synthetic stock position. I don't have a stock, but I have a synthetic stock position because I'm able to replicate the same risk profile as if I'm holding stock. Okay. So this is called synthetic stock. Now let's take it to a next level, right? Now, what's a covered call? In a covered call, you hold a stock, then you sell a call against that stock to generate an income, right? Now, I don't hold a stock, but I have a synthetic stock position. Let's get rid of this, which would behave like a call, which behave like a stock. So then, of course, I can sell a call against it. And there is actually a name for such a strategy that's called poor man's covered call. Because I don't have a capital to put $35,000 to buy 100 shares and then sell a call against it. I'm a poor person. I'll do a synthetic stock position and then sell a call against it. So this is called a poor man's covered call. Okay. You can do whatever you would have done as if you are holding a stock. Okay. Just that you're not going to get any dividend from it. Okay. And Now, this is what many of these yield max strategies, yield max is the ETF issuer, many of them they are doing, right? I think MSTY, CONY, all these income generating funds. If you go and look into the prospectus, they're not buying shares of MicroStrategy and then selling a call against it. All of them are doing a synthetic stock position, which is basically this. And then what they do is go and sell a call against it. Let's say I'll sell a call against it at whatever, pick anything, right? 400. So, let me just do a 400. I sell a call against it. So that means your upside is capped. But what they do is, when you sell the call, you get $37 as a premium. And what these yield max or other ETF issuer do is, the capital that you saved, you didn't have to put in $35,000, right? When someone does a synthetic stock position, the capital that you saved, they put that unused cash in a treasury to earn the extra income. So if you get into the prospectus of yield max, they'll tell you how exactly they're able to generate this. Is you're giving them $1,000, they're not going to buy MicroStrategy $1,000 stock. They're going to take a synthetic stock position on it, sell a call against it, and the remaining cash they're going to put in treasury, and then they're able to generate the yield, and then they are able to pass that yield as an income to you. That's how almost all of these ETF issuers, that's how they are able to generate an income and give it to you. Okay. That's a synthetic covered call. Yield max uses it as another name is PMCC, poor man's covered call. Mike is asking, good DTE for synthetic long? For me, when I'm looking at I mean, let's say if you are doing a completely stock substitution that you want to hold the stock for 1 year, 2 year, you can pick up 2 years. Again, you need to know how long you want to hold the stock, kind of stuff. Do sell 350 call, buy 350 put, and so MST around 350. Okay, yeah, 350 call, not buy 350 put. It's a other way around. So when you're going long, means then you're buying a call and selling a put. Buying a call is bullish, right? And selling a put is bullish. So basically you're buying a call and selling a put and getting, now this is almost equal to 100 shares, right? If you look at a delta here, below here, let me just show you.
So you bought
So if you look this delta.
Bought a call and sold a put.
Yeah. If you look at this delta, it's 100 shares. It's equivalent to 100 shares.
Okay.
So you get almost 100 shares exposure, and then you're selling a put against it. So in the put, I think this is like whatever 45 delta, you can, selling a call against it. So you can pick up whatever delta you want to sell your call against. This is how you could create a synthetic position on long stock. Now you can also do in a short stock. When you're doing a short stock, basically then just flip it. Oops. And now this become a short stock. I can't short MicroStrategy because it's hard to borrow. My brokerage firm doesn't allow me to do it. But I can do this. Of course, it comes with all the caveats of short selling, so that you shouldn't be doing the short selling of MicroStrategy anyway, but you want to do it, let's say for any reason. And if your brokerage firm is not allowing you to do it, maybe then you could do this. Your P&L is, again, it's a delta is negative 100. So this is why it is called synthetic, because you are able to replicate almost same behavior. Right? Now the synthetics are used, I've used in other context also. For example, I'll call it a synthetic strangle, right? Strangle because you can play on the both sides of the market. You can get a decent premium because now you're selling calls as well as selling puts. And let's say if I'm holding, like let's say pick up, let's continue the story with MicroStrategy. It's a pretty volatile, 104 IV. Say you just want to collect a premium. You have a no particular bullish or bearish sentiment on MicroStrategy. You say I'm here just to collect a premium, and let's say you want to go and sell close to 16 delta, giving yourself one standard deviation move. Oh my God, look at the skew on the call side. You have to go so far out to get to 16 delta. Right. Now in this case, you got $22 as a premium, right? And you got a wide range. And if you plot your P&L, this is which we're doing for 21st March. Very much. You're getting close to 75% probability of profit. Right? You've gone far out. And now that's fine, this triangle, but now you know what the risk you might run up into. Tomorrow, day after tomorrow, or whatever, Trump announces that we are going to keep Bitcoin as a strategic reserve, and then corporates jump into Bitcoin, MicroStrategy stock goes to the moon. Right? And you're exposed on the call side as a naked one. Right? So your losses continue to compound. What I would say is maybe do a synthetic strangle, means go out and do a wide, so you sacrifice some premium, but go and maybe pick up contain your loss and convert it to a very wide wings, maybe $100, $200 wide wings, so that in case if this continues to rip higher, you at least have some protection. Let's say go to do 150, right? You do lose out on a little bit on a premium. Let's say 150 instead of 160. So you're doing, so you do sacrifice some of a premium, but then you also reduce your risk a lot. So I would say in this case, it is like synthetically strangle. You can go even wider. It could be synthetically strangle, but not really a strangle because I have wider wings. And I would use this if I'm dealing in very volatile stock. Then I will not do a strangle on this one. Maybe call it synthetically strangle because about a very long call far away. There's a question from Jay. 351 tax treatment. So Jay, I actually covered this topic of how to diversify your concentrated position. There are some funds that allow you to do it. I think we had reviewed something from Morgan Stanley. I'll take a note of it, and next week maybe I'll tell you which session was it. But
no. Thank you so much. I think I heard something from Cambria, one of the managers. Let me.
Mark Faber.
Yeah.
He's been talking about it, but yeah. So I think there are a few companies that do it. So basically, you hand them over your concentrated stock portfolio, but then there are some restrictions around it. I probably have a brochure also because when I was studying it, and I talked about it in one of our previous sessions, in terms of, and this is used by a lot of these execs whose all their wealth is, because I'm a founder of a company, all my wealth is in this company. Now I want to diversify without taking capital gains.
Yeah.
But there are some restrictions on, you have to wait for 5 years, 7 years, and what you can get, what you cannot. But I'll let you know which session was it. We talked about it earlier.
Thank you.
Okay. All right. Now let's talk about some of the other strategies. Right. Butterflies. So this is I hate butterflies in terms of you can create butterflies using either calls or puts or combination of both calls and puts. I have seen all different flavors. I generally use both calls and puts, but you could use either way. But let me show you what does a butterfly is and how does it, where it could be used. Which one example I have? A DIA. Okay, let's go to DIA. Okay, so there is a butterfly with only puts. So in this one, basically let's look at the construction of this. You buy a long in the money put, then you sell 2 at the money put, and then you buy 1 long out of money put. So basically, let me put, it's going to be like this. If this is your stock price, right? You go and buy 1 above the stock price, buy 1 below the stock price, and sell 2 at the stock price. Okay. So let's go back to Think or Swim. Let's say DIA is whatever, 445. In this case, I bought 1 at 460 over here, 1 at 430, and sold 2 at 445, and gives me this P&L. Now you can, like I said, you can construct it using puts or using calls or using both put and a call. So I have one for a call as well. Let's say using calls, this is the one. And both puts and the calls will be, I guess, this is the one, right? Almost similar P&L graph. Now, I think rather than construction, more important to know why you would do this, right? If you don't expect much movement in the stock, remember it's a high value. In this case, you have a probability to make, because you got almost $10 as a premium. If a stock doesn't move at all, you get to retain all the $1,000 here, right? But if the stock moves out, you have a run a risk of losing $500. So in case, I would generally do this when the IV has spiked up, because let's say during that Japan, we have that yen carry trade when that blew up, right? When carry trade blew up, I did, and the IV was super high, and I knew that IV can't stay super high so long. So when IV will contract, these trades will come into profit pretty quickly. And that time I used this, right? Again, if the stocks move too much, your probability of profit is less. But if it stays within the range, you have an opportunity to make a lot of money on the same trade based on how much you're risking here. So that is butterfly. But there is a way to use it. There's a time to use it. Suitable for slow moving ETFs. Don't try to do on individual stocks which can move a lot. But if you have something which is slow moving, the reason is because you're collecting a lot of premium, because they're selling 2 at the money options. At the money options have a much higher extrinsic value. So you are selling 2 legs here, right? Either 2 calls or 2 puts, or a call and a put. And that's why you're able to collect so much of premium. And either if the IV crushes, or if the stock doesn't move at all or move little, you have an opportunity to make a lot of money on this one. So that is butterfly. Right? Now there's a variation of this, is a broken wing butterfly. Right? Maybe you know what? I don't want to take a risk on both sides of the market. I want to contain a risk on one side of the market, go risk-free on one side. IV is super high, so I do want to sell a premium, but what if the stock continues to go high? In this case, I will break this wing, and let's construct this one by, let's say instead of doing 4, where's my call? 445, 460, I'm gonna do 445, 455. Okay, not yet. Let's say go further down to 450. Now you see, I broke the wing. Now, if the stock runs up to, continues to run up too high, right? I have no risk. I'll make $180 if the stock goes to 460. So that's my max profit. So I've reduced the risk on one side. I broke, this is called broken wing butterfly. You know, this wing kind of got chipped. So it's called broken wing butterfly. But what are you giving up? If the stock damn thing, if it doesn't move at all, I could have made $1,000 and now I could make maximum only 680. So you have to see these, profit maximization versus the risk of stock moving. Okay, but it is a variation. Let's call a broken wing butterfly. There is another one called broken heart butterfly. I didn't have time to go through it, but you can change these wings and manipulate the width of the wings, and you can get a different P&L graph. So I've used, like I said, I've used this when the IV spiked up, and my expectation is that it will collapse and probably not much movement on the stock side. Okay. Next is zebra. This is a long term. It's called zero extrinsic value back ratio spread. Now we talked about back ratio spread. I don't do much back ratio spread. But let's say you want to go a short stock, right? But you want to have a fraction of the, sorry, let me go with this one, SPY. Right. So okay, all right. So what zebra does is, let's say if you're buying a put, or if you're selling a put, or selling, in this case, let's say if you're selling a call. Let me go back to this. Not really. So this will be equivalent to buying a put. So what expiration is? It's 21st expiration. Right? So this is basically if I'm bearish and I want to go short, or maybe I buy protection, I bought a put. If you buy a put, you are running against the time, like the theta decay, because let's say it's 607, currently it is here, and say I want to buy a protection. I bought a put, and let's see. So if I plot just this put, now the issue in this trade, I mean, almost similar P&L graph. An issue in this trade is that it has got an extrinsic value, what you're paying up for, which will decay over time. As stock doesn't move, stock doesn't go down, but it's got extrinsic value in it, which is theta decay, which is the enemy of option buyers. That's why I don't buy. So how do you eliminate this? This is where your zebra comes into picture, is zero extrinsic back ratio spread. Let's say instead of doing just buying a put, I would rather go and do this trade, in which now it has got a zero extrinsic value. Means if the stock continues to go, and of course my protection starts immediately at 607. And if you look at this, the way it is constructed is you pick up and at the money put. So you let me go this one. Let me tell you how to construct this. So in this case, the way you construct is you sell an at the money put, and then you buy. So when you sell at the money put, you're getting basically 6.7 extrinsic one, and then you go ahead and buy 2 in the money puts, the total of which will equivalent to the extrinsic value that you play. So it's more of a play on, I don't want to pay any extrinsic value because that will just die down. If stock doesn't do anything, I'm still going to lose money, right? The extrinsic value, I'm going to lose the extrinsic value. So this is to basically eliminate the theta decay or the extrinsic value from your trade. You can do it on a put side. You can do it on a call side. I think the call side example is here. Again, this has got a 0 extrinsic value in it. The construction is the same. You sell an at the money option, then go and buy 2 in the money options, so that the sum total of the extrinsic value comes out to be 0. And the risk is limited to whatever the debit you have paid. Right? So, but you don't have to pay for anything, any time premium on this one. Again, not stuff that I've used too much. Maybe I've done it once or twice, but not in my regular wheelhouse. But if you are the one who is playing too much onto, or very keen on the extrinsic side, Zebra could be a way to go. I think 2 more ones. Next is the lizard, which is Jade lizard, which is a combination of short put and a call spread. It is basically a strangle and the long call. So when I have done this many times, I have an example for PLTR. Right? Say I own a stock and or maybe I don't own a stock. I just want to sell a strangle. But then if the stock continues to go high, rip apart, I don't want to be, having losses. So basically I buy a call in such a way that the overall net credit is more than the width of your call spread. Then it is called Jade lizard. You can call it whatever name you want to call it. It is called Jade lizard, in which you basically add a long option to your strangle in a way that the width of the spread is less than the amount of premium that you have collected. Now, you could use this in combination of your long stock. I have done it many times. And that means if stock continues to go high, I don't lose any money in option, but also I'm getting money on the long stock position that I hold. Or you could use it alone also. And if you think my stock is not going to go more than 95, and if it stays up to 95, I'm going to make $533. But if it goes crazy and continues to go higher, all right, I'm not going to lose money. I'm going to make less money. I'm going to make only $33 because we hit a black swan event in which everyone is buying Palantir now. Or maybe white swan. I don't know. What's a good equivalent opposite of a black swan? So in that case, this may be a strategy to look at. Okay. Basically, you're clipping your losses on one side. Last one is a Batman. So we talked about ratio spreads. Batman is nothing but a combination of call ratio spread and a put ratio spread. You will see it when you see how the P&L graph looks like. This looks like Batman, right? The mask of Batman. We can put 2 eyes here. Anyway, so this is what a Batman is. It's basically, like I said, it's a combination of a ratio spread on the put side as well as call side. All you're trying to do here is trying to pin the strikes at this price point. Let's say you know that 16 delta is where it's gonna hit. You can do this trade. If it doesn't do anything, you haven't lost much anyway. So you're trying to play for a big move in the stock, but not too big. You based on whatever study you have done. I don't care. But if you think the stock would either go here, maybe let's say earnings, and the market maker move is suggesting you a $10 move or $15 move, but you don't know which direction the move will be. Right? So in that case, you might go and pick up and create a trade so that if it moves $10, exactly as what market maker would have expected, in either direction, I think this is what, yeah, this is $10. In either direction, you have an opportunity to make tons of money. In this case, you're gonna make close to $1,000. So, but very low probability because the stock has to, the only profitable zones are out here, and stock has to make that move. I think I've used it only once or twice in 2020. It is super expensive because look at it is got 6 contracts in it, so you have a higher charges, etc. Just for the fun, I think I've used it once or twice. But since we were talking about animal strategies, I thought I'll just bring this up just for information. Right, so that's Batman. But if you know you exactly where the stock might gonna land, or how far the stock gonna move, you can play on either direction using Batman. Other caveat is any of these spreads or these multi-leg strategies, when you're trying to manage it, it's a pain in the rear end. If you have to roll it or if you have to move it, it's not that easy. So that applies to even your normal spreads in to all the way to Batman. Forget about managing Batman. There are 6. You try to roll this, it's like a 12 contract trade. So, but that's a different strategy. There's another one called Crab, CRAB. I'm not looked into that one. I've never used it, but thought we'll share some of these exotic strategies of what you can do using options. These are very versatile. I think it's only depends on your imagination of what you want to do and how you want to play with it. So this is just a tool, but very powerful. All right. So with that, I think that's it for today. That was our agenda to get into these all crazy strategies. We've been talking about calls and puts. Yeah, that's like child's play as compared to these. But again, pick out whatever works for you, figure out, you'll experiment with a few. I've experimented with all of them over past many years. And I don't do all. Depending on what's the outlook is and what the situation is, we'll stick with that. So whatever works for you, stay with that. Now, I can stay around for another, till 12:30, right? So we have 12 minutes. If there are questions or anything else you want to talk about.
Hey, quick question. Will you be sharing this doc?
Generally the doc I don't share, but the recording will be there on the website.
Okay. And the other question I had was, so I've done few options. I do cash secured puts and call spreads, sometimes put spreads. But I'm not putting stops. Can you either show or give me your thoughts on putting stops?
So stop in you're talking about putting a stop loss on a stock?
Yeah. Oh no, on options. Do you do that?
No. I've never done any stop loss order in my life of investing, whether stock. So in case of option, spread is your stop. Right.
Okay.
So
if you're
let's
doing
say,
but one of the strategies I have been using is this was also called poor man's covered call, but I buy leaps and I sell calls around underneath it. So
yeah,
for
that's fine.
example, I had Baba, but Baba itself tanked, right? So So I can make covered calls, but I get this bad feeling of with the unrealized loss.
Losses. Yeah. Yeah.
But
So
it's unrealized, right? It
correct.
expires next Jan. So do you have a strategy around it? I mean, one way I was thinking was that I could put an alert on Baba and then go and, but
So your leap, and I'm assuming it's a deep in the deep in the money, because that's again a part of source synthetic stock position, because your leap in this
is that
case, let's say,
80 delta,
what delta was it?
80.
80, right? So it's kind of a behaving almost as if you're holding 80 shares of Baba. It's say another part of a synthetic stock position. Now you're selling your covered calls against it, so it becomes a poor man covered call. Now what the risk in this trade now, which you have realized, is coming from the core position, which is your long equivalent stock position of Baba. And
Yeah.
if Baba is not performing, your portfolio will not perform, because selling options on top of it is a gravy. Majority of the risk is in your synthetic equivalent of long stock position of Baba.
Yeah, that's why
Now,
I kind of moved to cash secured puts, even though the capital is locked. But if I'm at loss, I can start writing
so
calls,
so
do a
cash
bleed strategy.
cash secured put and a covered call are synthetically same trade.
Yeah. But with the puts, if I get assigned, right, then I can try to get out of it by writing calls.
Yeah. So I'm thinking, let's say, if you're doing your, let's say, Vista, if you're doing your cash secured put, right, or if you do a covered, so your cash secured put, your upside is limited. You
Mhm.
still have all the downside.
Yeah.
Covered call is the same stuff. You limit your upside by selling the call, but you still have all the downside from long stock position. So synthetically, both are same. To us, it might feel a little different. Let's say if you're selling a put, no, in that case, if it's a cash account, then even you don't get any margin relief. So you can do either way.
Yeah. No, it's just that I was saying if I sell put and it doesn't do well, I get it assigned, then I can start writing calls and come out of that hole. But in the other method, there is no way to come out of the hole, right?
Or you then just sell your leap. I
Or
mean,
just,
you're forcefully coming out. It's like, hey, I'm selling a stock because I can't sell option. Or you can, you sell
so
your.
you're saying
Let's
it's
say
just
you do a.
psychologically better to have.
Psychologically, you might feel it different, but portfolio wise, not much of a change. Or you
Yeah,
could sell near at the money call instead of going out the money. And when your call is that short call that you sold goes in the money, you sell your leap. Then you sell your leap
yeah,
because your leap would have profited, and then you get out of it.
yeah. Okay, thank you.
Yeah, synthetically, I mean, but there's not difference between them. And but
Yeah.
Does Baba pay dividend? Baba does pay dividend, right? Yeah, so you're not getting this yield on leaps.
Yeah. But 1%, I mean,
Yeah, I
yeah.
mean, right now it's 1% yield. Yeah, so it doesn't matter much.
Okay.
Three
So you
50.
have this once a month?
No, this meeting is every Saturday.
Oh, okay. I'll try to attend. Lots of good information. Thank you. Actually, for those who are beginners, I was going to recommend an options book that I came across. It's by Nishant Pant. Have you heard of him?
No, I'm a very bad learner from a book.
Okay. But if other people want to catch up, here is the book. It's I mean the guy is very risk averse and the whole thing is based on mean reversion theory. So
Yeah,
he
only mean reversion is volatility. Mean reversion, I don't know what Nishant is looking at, but that's the only mean reversion I find in a
he is
price is not
mainly
mean reversion.
recommending small accounts covered calls, covered positions, and starting with $500 and growing from there.
Yeah. Again, look
Yeah.
for all. There are a lot of information. Figure out what works. Take input from everyone, but and then you need to find out what works for you. So let me just search for Baba does not. Oh, so Baba does not pay dividend. She sings on live toss. Okay. I don't know why the paper trading shows 1.1% as dividend. What else? Another 5 minutes.
Hi, Vivek.
Hi.
So I just bought some ISRG this week because it shot way up and then it pulled back. And I've just, I've had it for a long time because I actually worked there. So it's done great, for me over the years. So I know it's really expensive at the peak right now. Is there a way for me to like guard against it dropping with some options? Like I wouldn't mind if because I think I bought it
so
at like
let's look at that.
584, 586, something like that. So
let's look at that scenario. Let's say I assume you got 100 shares of ISRG.
yeah, see, and I only have like 50 because I didn't have enough to buy like.
Okay, so let's start with 50.
Okay, because I mean, I don't I need 100 for an option?
No, you don't. And I'm just looking at what you have in your portfolio and how to protect it.
Okay.
So let's say you have 50.
But I mean, I can't sell a call or do anything until I have 100 shares, right?
You can, depending on what kind of a privilege you have on your option trading. If you have a
Okay.
privilege to sell uncovered calls, then you can sell a call. But if you don't, then you cannot. But
Mhm.
what you can do is, maybe sell a spread,
Okay.
right? And if you don't have 100 shares and if you're new to options, I would not advise anyone to sell a call which is uncovered. You
Right.
don't know how to manage risk and all that. So let's
Yeah.
look at this one.
Okay.
Let's say you have 50 shares of ISRG. Today it's trading at almost 585, right? Now what I could do is, if I had 100 shares, I would have just done a collar, but I can't do a collar because you don't have 100 shares. So, but what I could
I
do
mean,
is,
I actually do have 100 shares, but they're like at a different price from like 10 years ago or more. So,
okay, so let me just give you in terms of the different things strategy that you can use, and I've covered this in the bootcamp video of how to use options. But let's say I'll start with 100. There are a few things you can do, and there's no free lunch in the market, so you always have a trade-off. One trade-off is, hey, I want protection. Now, do you want immediate protection, or are you okay to, let's say, take a 10% loss? You tell me. You okay to take a 10% loss, but want protection beyond that? Not
okay.
10% loss, but let's say this, are you okay if the stock falls on 10% and below that you are protected?
Yeah.
Okay, so
How can
10%.
can I, like, for example, if I bought it at say 585, okay, or 586, for example, can I like make any money, like if I'm willing to lose that, for example, right? Like, I forgot what that's called, where I sell it. Like, would I sell a put on it or?
No. Okay. Now you're talking about, so I thought first you were looking at how do I protect it. So now you're talking about making money. You're
Yeah,
not really worried about if the stock goes down 5-10% because you want to hold the stock for long term.
correct.
This is a great company, but it's
Right.
just sitting there. It's not doing
Right.
anything for
Right.
me.
And I have a lot of stock like that that's just, well, not a lot. I wish I had a whole lot more, but I have some. And so that's like sitting there, like, but
Okay,
I don't want to sell the older batch because I don't want to pay any capital gains on that. So
correct. So let's do this thing. Let's play that scenario, right? What you could do is, this is what's called a covered call. We've been talking
yeah.
about it. is maybe go and sell far out of money covered call, maybe 600, 630 or 16 will be this. I'll go a little further out. Let's say 625.
Okay.
If you sell a covered call of 625, you're gonna, let's say close to midpoint will be $2.
Mm-hmm.
So you collect $2. Now the risk in this trade would be if ISRG goes to 625 or above
Mm-hmm.
in next 21st Feb, how many days are there? In 27 days,
Yeah.
then you will have to sell your ISRG shares or you have to take a loss on the option trade, but then your stock has benefited a lot. So now in this case, if let's say the stock continues to go higher, your portfolio continues to make money. I'm assuming only 100 shares and
Mm-hmm.
you bought it at 584, but beyond 625, you're not going to make any more money.
Okay.
But if you think that 625 is too far away, it's right now what almost $40 higher than where it is currently trading, and you don't think this is, and market thinks that there is 10% chance right now, 13% chance. But these things can change tomorrow based on what's happening in the market. But right now, market is saying, oh, there is a 13% chance that stock will expire at 21st February. It will be this or higher, right? But then you can make $2.
So that would be just $200, right?
$200 for 100 shares means $2 per share,
Yeah.
right? Now, depending on your outlook of this, you can, if you think, oh my God, the stock has already run up too much too soon, right? And if you're using technicals and all that, whatever, you think probably is gonna not run up much higher, you can come closer. Get to it. Then in this case, you'll probably gonna get $3.40 or 35 cents. But then the risk is if ISRG get bought over by another company and the stock goes to 700, you are basically cut off your gains at 615. So that's a decision that you have to make.
And what about something closer than February? Would that make any sense? I don't know how many they have.
I would rather, if I'm doing a new trade right now, I'm not doing anything for February. The closer you go, more volatile your positions will be. It'll become very difficult to manage.
Yeah.
And then you'll have to, every week you have to come and then put in a new one. And if you're not a full time doing this, I don't recommend anyone to do closer. You can collect a little bit more premium, but there is a risk, something called gamma risk, which starts to show up.
Okay.
Which I don't.
So then, so can you show that one more time? So it would be.
So 21st Feb.
Okay.
You can pick up whatever the strike price you're comfortable with. But let me tell you, if it is in a bullish market, covered call strategies have underperformed. You probably may be okay with just buying and holding the shares. But then let's say if the stock goes down, then you might want to, gosh, I should have sold a call. So there are both sides into, like, I know in 2021, some of the friends were like, oh, why did I sell a call? I got taken out earlier, right? I didn't enjoy all the upside. So in that case, I would recommend maybe instead of doing a call, maybe do a spread so that if stock goes to 700, you are still in the game.
Oh, and how would I protect on the downside? Like, say, if I think it might go down to.
So downside protection, let's say I'm assuming for 10% downside, you don't care. Say I want a protection beyond downside. So it becomes 580, goes down to 60. You could buy a put here, but then you're paying up for this.
Yeah.
So if you buy a put here, let's remove this and keep all of this. So your risk is limited only to 5%, whatever, till 580, right? So 580 is 10% risk.
Is that $520? That looks like $520, not $580.
580 is the current price. So I went down 10% down.
Gotcha.
And then protected. So beyond that, you don't, your portfolio doesn't go further down.
Mm-hmm.
Risk is limited to 520. You are protected beyond that. But then you are paying up for it. You are paying up $1.35 for it.
Mm.
So there is a cost. So basically, this is buying an insurance. You have a
Yeah.
cost to pay, and
Yeah.
this is your first 10% is your deductible. Beyond that, you are protected. You want less deductible, get closer, but then you have to pay higher insurance,
Yeah.
which is in this case, its deductible is $20.
So
Insurance.
then, so then the shares would just get assigned at 560?
No, so no, this put means you have bought a put means the shares will be sold. If the stock falls below 560,
Oh.
the shares will be sold.
But then, how is that different than just putting in a sale order at a certain price?
So you are saying basically doing a stop loss order?
Yeah. Oh, okay. Because I would be paying less, right? Because
No. So let's say you do a stop loss order, stock goes to 560 and then comes back up to 580.
yeah,
Your shares get sold.
yeah.
All right.
So then in this case, like it would cost me, say, $4,900, right?
This will cost you $490 for protecting 100 shares. So $4.90 per share.
So almost $500. So what protection is that?
Now this is you're buying a put, which I generally don't do it because it is expensive.
Uh-huh.
So
So if I bought that put, then what would happen to my shares? Like nothing, or I don't
nothing
know.
will happen to shares, but if let's say the stock closes below, let's say stock closes at 520
Mm-hmm.
on 21st February, your shares will still be sold at 560.
I got you. Okay.
Yeah. So you don't have any losses below 560, but let's say stock closes at 570, you still lost $15.
Yeah,
Anything you're protected below 560.
got it.
Buying
So
puts is an expensive
yeah,
mechanism.
yeah.
Long term doesn't really help. So I don't
Okay.
buy
So
puts.
then you don't think the covered calls would actually help make anything either?
Covered calls will be reducing your cost of ownership,
Yeah.
and it does help. The other thing is, I mean, if you own, let's say, more than 100 shares, maybe do only one covered call.
Mm-hmm.
So that even if that share get called away, you still have the other shares which will
Yeah.
continue to benefit you if stock continues to go high.
Mm-hmm.
Other thing is that, hey, I want a protection come what may, and then you could buy a put but sponsor it by selling a call against it.
Yeah.
In this case, you don't pay up much, but then you have a risk if the stock goes higher, you have to give away your stocks.
Right.
So there are choices that you have to make.
Yeah.
There is no one correct answer, and
Right.
based on what you are comfortable with. If you want 100% protection and you don't mind paying up for it, go buy a put.
Hmm.
Right. I
Yeah.
don't want to do that, so I generally will do collar like this, or I will continuously sell calls against my position or some of
Yeah.
the positions.
Right.
If my stock cost basis is reduced down to 50%, 60%, then I already built a lot of buffer.
Gotcha. Is there anything that you recommend right now, like to buy?
I don't recommend any stocks to buy. If you right now, I'm not bringing any additionally. Whatever the consistent, regular investment in the stocks that people are doing, you should continue to do it.
Uh-huh.
And if you're not interested in any individual stocks, then stick with the SPY.
Yeah. Yeah. I just went in for Intuitive because it's just always been such a solid player. But
It's a
my
good company.
portfolio is like, so, they would like be really mad because there's like no diversity, it's like so much in one place. So, but
Yeah,
I
so
don't
if
know. It just seems to be such an amazing stock, and no one talks about it, but it's a company with almost no debt, no competitors, and it's just performed extremely well. So,
I mean, there are some small Chinese companies, but yeah, none. In fact, I have one of my friend in Intuitive, so I actually visited Intuitive surgical office and had a lunch with him in the
yeah,
cafeteria. It's a great office. You guys have a great office on Kaifa Road.
yeah. I'm unfortunately not there anymore, but
Oh, okay.
I was there, 10 years ago. So yeah, because I was searching and even I asked ChatGPT, I'm like, is there any, company with a similar profile? And there was just nothing. There was nothing with that valuation plus no debt, So I feel like the no debt's important because if the economy does go down, right, like they're going to survive.
Again, the combination of debt and the equity is a game that CFO needs to do in terms of the return for investors. If you're not taking any debt, you're actually reducing the return for investors. So
Yeah,
judicial use of debt is again
yeah,
a trade that a CFO should have. I
yeah,
would not say that no debt is great. If you have a consistent visibility into your income, it's a great
yeah,
time to have debt. Telecom companies, utility companies are always loaded with debt because they know they will always get their bills. Customer will pay the bills. So
I
they
know.
don't mind taking on
Is
the
there a
debt
debt
because they are making
ratio that you think is good or bad?
Sorry?
Is there any ratio that you think is good or bad for debt or like,
So debt to equity, I don't, I look at anything, let's say beyond below 1.5 or 2 higher is not good, but depending on the business, if you have a consistent income, then
yeah,
I think that is not bad. Anyway, so I guess I'll close it down here. Thank you everyone for joining in, and I'll talk to you again next week. So I got ISRG, I got NATR Natera. So 2 companies for our next week.
and also like NVIDIA, of course, like you could expound on that a little bit because
NVIDIA, there are like a literature, dozen literatures available. I
yeah,
don't think I'm going to add any more value to NVIDIA.
okay,
But I'll bring up the business metrics, and it looks great on NVIDIA.
it still looks good.
Yeah.
Okay.
I'm not sure about the valuation though. Business is good.
Exactly.
All right. Thanks,
Okay.
everyone.
Thank you so much. Bye
Thank
bye.
you. Bye.